The concept of materiality as it relates to sustainability reporting is critical because it determines what information gets disclosed and to the extent to which it's disclosed, because obviously it's driven by who the reporting is for. So how has the working group approached materiality within the South African context?
That has not been left necessarily only to the ARWG. By the time we were set up, there had been a couple of studies prior to the constitution of the ARWG, where I think it was SAICA also had set up a sustainability technical committee who produced a certain report, which found that South Africa prefers double materiality approach. Our own RIA, or the DTIC's regulatory impact assessment, also found that the reporting community prefers a double materiality approach. We partnered also with Alex Forbes. That study also surfaced double materiality as the preference. So currently that's the take, or that's the preference, not government's one, but the market's one. And since we are here to support the market, but also achieve our regulatory objectives, largely, I think, I guess from a CIPC perspective, Section 7A speaks about ensuring that our enforcement of the Companies Act achieves it allows giving better vent to the Bill of Rights and the enjoyment of rights. So it's currently sitting at double materiality, but then to what extent and scope and degree do we mandate impact materiality? So that's it's going to be quite interesting where we land with that. The financial materiality side of things is quite straightforward because, like I said, we're leading largely on the IWSP standards, which are more on financial sustainability related risk and opportunities. So on the GRI side of things, and I'm just giving GRI as an example because in our studies we found that that standard GRI is largely used for sustainability reports as well. But so once the mandate kicks in, where do you draw the line? What constitutes decision useful information insofar as impact materiality is concerned? So the next dialogue, in fact, the current dialogue and the public consultation will distill those indicators, which we will be deemed as being the minimum set of impact disclosures required by a broad group of stakeholders. But where the baseline or the core is to facilitate access to capital, reduce the cost of capital, and reduce also the impact or risk or shocks on cash flow around sustainability related risks. So yeah, it's going to be quite interesting, but we are leaning strongly on double materiality.
So that's one part, but then there's also the part around sustainability reporting that looks at driving better sustainable business practices, as well as better governance and better decisions and ultimately better outcomes within the corporate space. So reporting doesn't drive behavior. However, it changes. It's just a matter of information that it gives us so that we can make decisions. However, what opportunities are you seeing with sustainability reporting that will enable or drive or encourage corporates to shift in some of the ways and spaces that drive negative or adverse business practices?
Yeah, no, beautiful question once again. So up to this point, the noise, if I may use that word, around the push for making sustainability reporting mandatory was militating on greenwashing and greenwashing, I guess, as well. So I mean, some companies had made commitments to decarbonize or achieve net zero by a particular date or juncture, and then they pushed back on that, or that's where the greenwashing aspect comes in. They rolled back on those commitments, but they had already attracted finance or received, sustainable finance for specific projects. So, so that was the one part that was driving some jurisdictions to mandate, so that that kind of behavior or practice is discouraged. And also on the greenwashing aspect, I mean, like I said, before IFRS S1 and S2 came into play, there was GRI, but the manner in which assurance played out, whether limited assurance or reasonable assurance were applicable, was also subject to too many gray areas. There was no standard set of an assurance standard. Only ISA 5000 came into play recently, so that will deal with the credibility of sustainability disclosures. But prior to that, you were either dealing with ESG rating agencies, and an interesting mix or cocktail of other consultants and organizations. So I think what the mandate does for us as regulators is to, one, like you said, it will force boards or those charged with governance to strengthen the controls of the data sets that eventually culminate in a sustainability report. But beyond just the controls, from a governance perspective, the actual operations, they will have to be more deliberate and intentional in achieving the outcomes they commit to. So again, I'll give you an example of how Treasury has now assumed, or came out to say they will assume the role of impact reporting under the Sustainable Finance Policy Framework. So even though that may not necessarily be enforceable explicitly as a function of the Companies Act, there is a direct connection to how companies who will trade with the state report on various financial instruments that are geared or earmarked for social purposes. So the accounting aspect then comes into play there. The traditional accounting aspect comes into play insofar as on the accounting side of things, with how the integrity of those disclosures will be gauged, measured, and assessed on the back of IWSP standards and the ISA 5000 for assurance on sustainability reports, as well as there's another standard coming out, I think ISA 3000, but that's more on ethics, assurance on the ethical piece. So there is an opportunity to, one, enforce a higher or deeper dimension of accountability and transparency. It's an opportunity to shift behavior beyond tick box exercises, beyond just rushing through the financial year end to produce a financial report and present it in the AGM. It's about collectively creating a catalytic environment which causes the micro level playing field to start recalibrating itself, so that as a collective unit, it shifts the economy in the direction that we have imagined or reimagined, where things are no longer, we're no longer reacting to things. We're now proactively planning as a function of business strategy in order to remain resilient, take advantage of the economic shifts, take advantage of the transition, so that we position ourselves as a leader, or as a leader in the global marketplace, and how we can gain a better market share in some of the value chains where we have comparative economic advantage, among other things, as a nation.
So moving on to the roadmap itself, in terms of where is it, where we're going, and so what are some of the milestones? What is anticipated in terms of the timelines for implementation, and what factors are influencing the pace of adoption?
Okay, one, the timelines are not cast in stone. The reason being is that for us to say we are now adopting, well, I mean, we can make the pronouncement about adoption, but as to when the effective date will be, the transition reliefs, and then the requirement to have the reports assured, limited assurance or reasonable assurance, and then bring in comparative year disclosures. All of that is a function of the current draft roadmap. So we've simply said by 2028, yeah, the DTIC said by January 2028, we will start using the standards, even though we permit or encourage early adoption by the market. The government will make the pronouncement to begin the mandatory reporting regime January 2028, subject obviously to the level of preparedness of the reporting entities who will be the subject of the first cohort of reporters. And that again is a function of the roadmap. Are we dealing with listed entities, JSE, Cape Town Stock Exchange, A2X, etc.? Or are we dealing with listed entities and large unlisted entities? And what do we mean by large? Are we using the variables around the PI score, or what else? And which threshold in terms of the PI score? Because sometimes entities have a large employee base, but insufficient or revenue. And then you have those who are just purely institutional investors who don't employ a lot of people because it's capital intensive business transactions or business models. So there you have large assets, but low number of employees, low debt. So that whole computation of the PI score might not be the best variable to use in informing who must report and by when. So again, that's a function of the National Adoption Roadmap, and will be consulted on with the public from around about September, October. But we do what we've said, apart from the 2028 January target date, is we will recalibrate the roadmap once endorsed by Cabinet to factor in proportionality or proportionality mechanisms, as well as the degree of readiness of various stakeholders, or let me say reporters. That speaks to the skills required to produce quality reports. It speaks to the enterprise reporting processes and technologies or capabilities in-house in order to glean credible sustainability data that will culminate in assured sustainability reports. So where we as government may come in is to create a fund that cushions some of the assurance costs. It may be a fund that twins sustainability practitioners, environmentalists, etc., and have them deployed to the cohort of companies who will be the first cohort that's impacted by the mandate, and assist them with the skills. This is now absorbing the cost rather of those experts and skills. Just to give you an example, I'm not saying that program is there already, among other things. So readiness is really the underlying factor that will inform the kickoff date or the effective date, and then the transition reliefs also will be informed by the degree of readiness on tier 1, 2, and 3 reporting entities. This is inclusive of the value chain considerations.
In the adoption process, you've identified that definitely listed companies will potentially be part of the companies that are required to report, some unlisted, which are the large and medium size. But then the SMMEs, I think is left with a question mark as in terms of their requirements from a reporting perspective. What does that look like for them? Yes, they'll potentially form part of the value chain of listed and unlisted entities that are required to report, but specifically for them, is there any consideration around what the sustainability reporting looks like?
Yeah, no, definitely. I alluded to the proportionality approach, right? Or phasing in of various groups of reporters into the mandate. And obviously reporting maturity is different for SMEs. The actual data around sustainability is also not readily available. Sometimes it's there, but it's informal. The governance around the data points for sustainability reporting also is absent in some cases, and there's a lot of information asymmetry in the SME space. So we have considered them, and one of the propositions by the Adoption Readiness Working Group was to include or consider the inclusion of a 10th cluster group, because we currently have 9. So they said the 10th one should be SMEs, and we might call that 10th cluster the proportionality cluster or the MSME cluster. I don't know, but that's one of the things we grappling with, and I think will be the subject of attention in the next agenda of the ARWG meeting when we meet in August. But it is receiving attention largely because we consider SMEs as a key player in the economy and their potential of contributing towards catalytic economic growth. Whether you're looking at small SMEs where it's owner managed or more sophisticated ones, either way, the manner in which they are structured and the manner in which they operate is not what's the word I'm looking for. It means the architecture in which they operate is not largely properly regulated. The enterprise and supply development programs have their place, but they might not achieve the kind of inclusivity where we have imagined insofar as the sustainability reporting domain is concerned. Because again, opportunities to participate in sustainability are not limited to the reporting ecosystem. There's the export readiness program, if I may give an example that DTIC is responsible for. How do we take advantage of the transition to bring in more SMEs into the export space by leveraging sustainability thinking to say there are opportunities perhaps in the Green Deal, the Europe's Green Deal. But for them to participate effectively, they need to meet specific criteria or certain criteria required by the ESRS. So how do we take advantage of that to bridge the skills gap and the readiness gap so that we don't just impose a reporting burden on them, we actually make them competitive to plug into opportunities in the global value chains, among other things.
I like the fact that there is some thinking around that as well, but obviously everything is going to be phased. I have so many other questions, but time is running out. So just like my last 2 questions, 5 years from now, when we're judging our decision to incorporate mandatory sustainability reporting and everything that has gone on, what does success look like as it relates to its contribution to South Africa's broader economic and social objectives?
Yeah, that's a great question, and I think it's answered. The answer to that question is the function of the current consultation process. We obviously, from a regulatory perspective, do want to see an increased move in capital flows, right? That may either mean DFI or even internally, let me say, as a jurisdiction, where we now create the kind of circumstances that allow our own capital to fetch a higher market price. You know, Honorable Minister Gwede said something quite profound about 2 months ago. He came up to say we're now reclassifying coal as a critical mineral. So previously we had been working around the economic model that coal is now a dirty asset, and so it's going to be a stranded asset, and then business units which relied on coal for enterprise value would be stranded assets as well. So those cash generating units around coal, started becoming being impaired and being endangered species, if I may call them that. So once you use classification of coal as a critical mineral, change the ball game or the nature of the game altogether. So the discussion and the dialogue now is slightly different. So the future that we are imagining, or what success looks like in the future, is where South Africa's natural endowments are recognized for what they are from a taxonomical perspective, because that's super key. The way we define things and classify them, determine what their value are in terms of measurement, recognition, etc. So we first have to ensure that we set the tone of the negotiation terms. And that means we must defend our territory by being vocal about what we think value is. We've got rural land which sits idle because of the economic architecture. So we're going to have to re-engineer the economic architecture so that even rural land is reimagined to fetch a higher value in the market than what it is now, simply because it's rural and it's under tribal, traditional authorities, etc. So the future is more inclusive. The future is one of shared prosperity. The future is one where we move from marginal gains to transformative gains.
So finally, if you could leave business leaders, investors, policymakers, and citizens with one message regarding the importance of this reform and how they can play a role in it and what their part would be, what would you say?
Because the urgent call of the hour is for us to collaborate, move away from the old paradigm of competition to one of collaboration. There's, the old economics is based on what one author called red oceans. So we're now dealing with blue oceans, which largely leverages the synergies that come from collaboration. So I'll say we need to work collectively and own the transition. And I'm not talking about energy transition or climate transition. I'm talking about economic transition. All those variables I mentioned are a transition that is caused by the nature of economics. There is a definite economic change. Businesses are becoming more sophisticated. Value chains are becoming more sophisticated. So let's own the transition. Let's come to the forefront of the movement. Let's defend our territory collectively. And again, let's consider how we incorporate or feature sustainability prominently in our business strategies as an enabler of executing the strategy, as opposed to it being an afterthought. So those would be my closing remarks to business. Thank you, Namhla.
Thank you. Thank you very much, Cuma. And I think the main thing that comes out to me with regards to this whole sustainability reporting and obviously from a regulatory perspective is like, how do we ensure resilience? How do we ensure the resilience of business? How do we ensure the resilience of society? And how do we ensure the resilience of the environment as well? Because the environment and society are key input into business and obviously the government as well and their objectives. So thank you very much for your time. As I said, I've got other questions, but we'll see how we'll do them in another time. And I really appreciate your time. And yeah, thank you very much.